Greetings, ladies and gentlemen. Welcome to Liberty Call. Today is Thursday, January 5th, 2023. Hope everybody's having a good day out there. Not the best day in the markets. Looks like most of the major indexes here were down more than 1%. Stocks are in the red most of the day, but again, not really surprising. I think people are kind of coming to grips with, hey, I think we might be in recession. Hey, there's lots of headlines that there's, layoffs with, I saw 18,000 with Amazon, which it's like less than 1% of their entire workforce. But let's see, Goldman Sachs, I think there were a number of big names out there that are trimming their workforce. And quite honestly, you could probably do that once a year and probably most companies would be all right. So anyways, if it's your first time watching, please give me some thumbs up, likes, share, subscribes. I greatly appreciate it. And let's go ahead and jump into the news. All right, Dow Jones finished the day down 1.02% at 32,930. S&P 500 was down 1.16, closed at 3808. NASDAQ down 1.47, closed at 10,305. Small caps were down 0.79. The VIX was up 2.27 today. It's at 2251 right now. Let's see here. Canada down 0.42. Brazil up 2.18. Let's see here. Mexico up 1.24. Across the Atlantic, Germany down 0.38, UK up 0.64, France down 0.22, Euro stocks down 0.36, Netherlands down 0.44, Italy was down 0.11, Switzerland down 0.74, and Portugal up 0.24. In Russia, both exchanges were red again today. The MOEX down 0.54, RTSI down 0.95. And the overnights, I see a lot of greens here in the European or in the Asian markets. Japan was up 0.4, Australia up 0.06. In China, the Shanghai was up 1.01, the SCSE component up 2.13, China A50 up 2.47, DJ Shanghai up 1.18, and the Hang Seng up 1.25, and the Taiwan weighted came in up 0.72. So looks like the Asian and the Far East did far better than in Western Europe, and definitely better than here in the U.S. So, but again, not to really be surprised. Let me bring up my long-term chart here, and we can take a look at that. We can see, going back to the beginning of last year, we've been in this downtrend. This is the S&P 500 that we're currently looking at. And, until we break this, downward resistance trend that we've been in, I just really don't see us, seeing any, at least long-term upward growth in the equity markets for the time being. Being that, the yield curve is inverted. It was inverted last year. And with everything else that's going on, I think probably somewhere around mid-year, that would be my best guesstimate, would be when things are probably going to start normalizing. People come to the realization, hey, we are in a recession, and, we'll go from there. But until people, really feel it in their pocketbooks and, there's blood in the streets, I don't think we're really going to see much of a change. So. All right, well, let's go ahead and read through today's recap. S&P 500 stumbles on rising Treasury yields amid fresh signs of hot jobs market. The S&P 500 stumbled Thursday, paced by a slump in tech from rising Treasury yields as data continued to point to a tight labor market just a day after the Federal Reserve's December minutes signaled more rate hikes ahead. Again, not shocking. A duo of reports showed that better than expected private job gains in November and fewer initial weekly jobless claims firmed up bets that the Fed will have more work to do to restore supply and demand balance in a tight labor market that threatens to push wages higher. Private payrolls grew by 235,000 in November, according to a report released Thursday by ADP and Moody's Analytics, well above economists' forecasts of 150,000. Initial jobs claims fell to the lowest level since September 24th, with economists warning that claims were likely a trend higher despite the recent headlines of layoffs at major companies. Quote, the most recent Challenger data released this morning suggests that these layoff intentions may have hit a peak in November, Jeffrey said in a note. Federal Reserve Bank of St. Louis President James Bullard cut a less hawkish figure following data, saying that while inflation is too high, the rates are getting closer to a sufficiently restrictive zone. Treasury yields jumped sharply on the news, putting pressure on the rate-sensitive sectors of the market, including tech. Microsoft was the biggest drag on tech for the second straight day after UBS raised concerns a day earlier about slowing growth in the tech giant's cloud and office businesses. Oppenheimer, however, said Microsoft looks, quote, attractive, and dismissed concerns about prolonged weakness in cloud growth, saying secular growth should resume from massive improvement in cloud productivity and dozens of new unforeseen PaaS-like services and apps. Amazon, meanwhile, fell more than 1% after the e-commerce giant confirmed plans to cut just over 18,000 jobs to save costs. The move followed an earlier warning from the company in December when it warned of, quote, more role reductions, end quote, in early 2023. On the earnings front, pharmacy operator Walgreens Boots Alliance raised its full-year outlook after reporting, excuse me, better than expected quarterly results, but its shares fell 5%. Bath & Body Works plunged 30% after warning of bankruptcy as losses mount. The home goods retailer said it expects to report third quarter revenue of $1.26 billion, below Wall Street estimates of $1.404 billion from analysts. Energy was the only sector in the green, underpinned by rising oil prices, followed mixed weekly petroleum data showing a larger build in U.S. crude supplies, but smaller increases in gasoline supplies. Valero Energy Corporation, Copper Futures, and ExxonMobil were among the top gainers, with some on Wall Street continuing to favor the sector as a slowing economy isn't likely to significantly dent energy demand. Probably true, especially since it's winter and it is cold. Quote, we like ExxonMobil and the oil and gas space because there's a limited supply of oil and gas and demand hasn't been impacted that dramatically, end quote, said Austin Graff, founder and chief executive at Opal Capital, told Investing.com's Yassine Ibrahim in an interview on Thursday. Quote, historically in recessions, or at least minor recessions, demand doesn't take a massive hit, end quote, Graff added. On the geopolitical front, Russian President Vladimir Putin, the bad guy, reportedly ordered a 36-hour ceasefire over Orthodox Christmas on January 6th through 7th, but hopes that the move could lead to peace talks appears slim, as Putin said a condition for dialogue would require Ukraine to accept the new territorial realities, which include the occupied territories annexed by Russia. Ukrainian President Advisor Mikhailo Podolyak rejected the proposal for a temporary truce and called it a propaganda gesture. Yeah, the Ukrainians are going to get their ass kicked. That's just, there's no two ways about it. It's unfortunate that, their friendship with the West and NATO, and especially the United States, is going to wind up getting a lot of their friends killed. So, anyone who, a wise person once said that if you want to see who our enemies are going to be in the next decade, just look who we are funding currently. Yeah, I mean, you just look back historically at ISIS, Syria, all these other countries that we've dumped money, Iraq, back in the 80s, all these countries we dump, money and arms into, and then mysteriously they wind up being terrorists and our enemies a decade later. So I guess, Ukraine will be our next, problem child in the next decade if the Republic manages to last that long. All right. On the economic data front, weekly jobless claims dropped to 204,000, Labor Department. The number of Americans filing for unemployment insurance unexpectedly fell last week, according to new Labor Department data on Thursday. Seasonally adjusted initial jobless claims fell to 204,000 in the week ending December 31st, decreasing from a downwardly revised figure of 223,000. Economists had predicted that the reading would inch up to 225,000. So they thought it'd go up. It actually went down by 10%. The 4-week moving average, which aims to account for volatility in weekly readings, dropped by 6,750 to 213,750. Meanwhile, continuing claims, a gauge of the amount of U.S. residents filing for ongoing unemployment benefits, declined to 1.694 million from 1.718 million last week. Forecasts anticipated that number would slip to 1.708 million. So again, the guesstimators were off on that one. So again, good news. People who have jobs or want jobs seem to have them, and those who are content to sit around unemployment like lazy asses. I guess they can still collect their money. Next up, Goldman Sachs says interest rates will be central to 2023 returns. So let's read through this quick article, and I'll give you my reading between the lines of this. In a note to clients Thursday, Goldman Sachs analysts said that the path for nominal and real interest rates, quote, will be central to the returns for 2023, end quote. In a note focused on what to watch in 2023, Oppenheimer said economists expect inflation to ease this year, but persistent higher wage growth and the, quote, the recent easing of financial conditions could push the Fed and other central banks to higher peak rates than currently priced, end quote. This would push valuations lower, and the analysts argue. Goldman Sachs is also watching the pace of growth, earnings momentum, and margins in 2023. Quote, valuation matters in equity markets in 2022 for the first time since the global financial crisis. Generally, cheaper markets and sectors outperformed. We expect this pattern to continue at least until interest rates start to fail and relative valuations further mean revert, end quote, the analyst added. Quote, while we expect a turning point in the markets this year, the hurdle rate for investing in equities has increased. There is now a reasonable alternative return available in bonds and cash. We expect a relatively flat and fat market environment, end quote. So what are they really saying here? What they're saying is that the equity markets are not going to boom again until the Fed drops rates, and I'm sure they'd love some quantitative easing along the way. So it's kind of their little idle threat. Hey, Fed, if you don't play ball with us, and the Wall Street's not really going to like it, and it might hurt things down the road. So it seems kind of like a veiled threat to me that, hey, until you actually get rates back to, well, let's get them back down to zero, because the economy was running great for the last 15 years at zero interest rates. Well, unfortunately, you were building up a time bomb of cheap credit and money, and now we're seeing what happens when that explodes. So to me, I look at it as rates are finally normalizing and getting back to what they should be. We're going to have to go a little higher to get inflation back down, but mortgages at 2% and 3%. I mean, that's just nuts. That from a risk reward perspective, I mean, if I'm lending someone $500,000 for 30 years, I think I want more than 2 or 3% on my return for that investment. And, that's really the way you need to look at things in this environment. So, all right, got one last article here, has to do with some savings tips. The era of 4% savings accounts has finally returned. So here are 7 actual smart ways to make 2023 the year you save more. The number one financial New Year's resolution for 2023 is to boost savings, according to a recent Bank of America survey. And while building a savings account has never been easy, many savings accounts are now paying more than they have in a decade. That means that at least on the interest earning side of things, you'll be able to boost your balance easier. Number 1, open up a high yield savings account. The national average annual percentage yield, or APY, for a conventional savings account these days is 0.3%, according to the latest FDIC data. Taking advantage of a high yield savings account like one of these, on the other hand, can deliver an average percentage rate of around 3% or more. Amy Hubble, principal investment advisor at Radix Financial in Oklahoma City, said for those with savings still parked in low yielding bank account, now's the time to act. Quote, now is that interest rates have increased. Many online savings accounts through banks such as Capital One or SoFi can offer rates over 3.5%, she said. Max My Interest CEO Gary Zimmerman says it's also critical to read the fine print attached to any of those accounts. Quote, make sure your money is held directly in your own name and in your own FDIC insured savings account, end quote. And Zimmerman says, quote, be wary of fintech apps or cryptocurrency platforms that promise high yield. There is often a catch, end quote. Another area to consider are fees. Zimmerman adds, quote, if there is a monthly fee on a bank account, it's a sign that that bank does not want your business, end quote. Number 2, play it smart with that holiday bonus. With the 2022 holiday season now behind us, Hubble says that those who were fortunate enough to have an employer who offered holiday bonuses should likely use it as a boost to their savings account. Quote, make sure that a portion of any bonuses or gifts that you receive go towards your savings goals so that by this time next year, you're not, again, making a pledge to begin saving, end quote, he says. Number 3, exceed your employer match. A Vanguard report found that the average employer match is somewhere in the ballpark of 4.5%, but Hubble says that isn't necessarily enough. Quote, many employers will also match a portion of your contributions, but a mistake many people make is by limiting their contributions to the amount their match, often 3 to 5%. Hubble says, adding that all Americans need to be saving at least 10% of their income, regardless of their age, in quotes. And I would probably recommend it, get in the habit of trying, if you can, do 25%. As you get older, you're probably not going to do that much. But when you start young, saving a quarter of what you make, it makes it a lot easier as you get older and you don't spend every dollar you make and not have anything left. And in 2023, maxing out your contribution limits for both your 401ks and IRAs is even more lucrative. Employers who participate in 401k, 403b, most 457 plans, and the government's thrift savings plan can now contribute as much as $22,500 per year, according to the IRS. That's $2,000 more than last year. For IRAs, contribution increased to $6,500, up from $6,000. Number 4, go paperless. It may be small, but it's an easy way to save money, so we're including it. Convert your bill pay to paperless, says Bunio. Everyone from cell phone companies to insurance companies to financial companies offer discounts to those who opt out of paper statements. Number 5, set long-term goals. Although financial markets largely posted losses this past year, the longer-term results tell a different tale. Take the S&P 500, for instance. Its year-to-year date figures, as measured by the SPDR S&P 500 Trust, also known as SPY, posted a loss of 18.04% as of December 26, according to Morningstar. Over the past 10 years, however, the tracker has annualized gains of 12.45%. Gene Sutton, a certified financial planner and managing director of Strategic Retirement Partners in Nashville, says figures like this are just why it's critical to set long-term investment goals and not just focus on the short-term turmoil. Quote, a long-term diversified investment strategy supported by a financial plan is optimal for almost everyone, end quote, Sutton said, adding that it's also important to savers to, quote, pay particular attention to time horizon and not necessarily time to retirement, end quote. She adds that it's important for people to understand that, quote, the day you plan to actually start distributing from your accounts may be very different than your actual retirement date. The same goes for younger investors saving for shorter goals like a first home or a kid's college, end quote. Number 6, let's see here, deal with your insurance coverage. Whether it's medical, car, disability, homeowners, or another kind of insurance, many of us get a plan, then stick with it for years and years to come. And that means many are overpaying. Switch providers, and you might be able to save hundreds of dollars per year. Even if you're happy with your provider, it's still worth looking at your coverage. One should always look at their current what their current plans cover. What are they getting out of it for the monthly cost? It says Nicholas Bunio, a certified financial planner with Retirement Wealth Advisors in Berwyn, Pennsylvania. The average 40-year-old adult in 2023 will spend $477 a month on health insurance, according to a Money Geek report. And while there's no arguing the importance of health coverage, there is such a thing as being in the wrong plan, says Bunio. Quote, for example, my parents are on Medicare. Bunio adding that their Part C coverage also their Part C plan also covers dental, yet they were paying $70 a month for a separate dental plan. Eliminating this extra plan is almost $900 per year in savings. And lastly, make a budget that plans for fun along the way. Tess Zigo, an LPL advisor, says the most critical factor of all when setting up a comprehensive spending plan is to create your spending plan that encompasses enjoying yourself today, whether it's through travel or other things that matter to you. She adds that being responsible with money doesn't mean you have to pinch pennies and only save. If you're not having fun along the way, it defeats the purpose, end quote. All good tips there. And the main one was that savings accounts are now starting to pay, or especially the high yield savings, are starting to pay a decent rate at this time. So if you need to start moving money around at your banks, if you need some help with that, let me know. I'll be happy to do some research for you and find something that probably pays better than your regular savings account at your standard brick and mortar bank. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there, and hope everyone has a fantastical evening, and I'll talk to you next time. Adios.